My name's Adam, otherwise known as InTheMoney, and today I'm going to teach you how to trade options in Robinhood. I know firsthand how frustrating it can be looking all over the internet trying to piece little parts of the puzzle together, trying to form the bigger picture of what options are, but not being able to do so. So if you're trying to get the full picture in one go, in one spot, then by golly, you've come to the right place. This video is all chopped up into sections, and at the end of each section, there's going to be a list of questions. And those questions are there just to make sure that you're fully tracking with the important topics of each section. So if you want to make sure that you are fully tracking everything that's going on, you can kind of quiz yourself, and the answer to those questions are in the description below. Grab a pen, grab a paper, grab a snack. Highly encouraged. Let's jump into it. So to get to a page like this, you're going to want to search up a stock. You can do AMD if you want to follow along. So search up AMD in Robinhood and tap on trade, then trade options. It'll pull you up to, I think it says discover. Go up to the top and tap on any of the dates up there. And it'll take you to a page that looks very, very similar to this one. The numbers are going to be different, but the layout itself is going to look very similar. And what we're looking at here is 4 different call options. So there's a 49.5 call, there's a 49 call, 48.5 call, and a 48 call. So these are 4 separate call options. And if you have your phone open, you can scroll up and scroll down and you'll see there's a lot of different call options. These are not the only 4. There's a lot of other call options, but these are all that we need to learn and understand the basics of these options. What is a call? Well, it is a contract between a buyer and a seller. And in pretty much every example today, we are going to be the buyer of these call options. So we buy these call options from somebody. We'll discuss how you do that in a little bit. But when you have this call option in your possession, it gives you the right to do something. It gives you the right, but not the obligation. In other words, you can, but you do not have to, buy 100 shares of the underlying stock at a strike price. And I know that might sound a little confusing, so I'll break it down here. So AMD is our underlying stock. It's called the underlying when you're trading options on a certain stock. So it gives us the right to buy 100 shares, right? It gives us the right to buy 100 shares. But not only that, it gives us the right to buy 100 shares at a strike price. So let's say we have this $48 call here. $48 is not how much you pay for the call. $48 is this call's strike price. So if we have this call option in our possession, we can buy 100 shares of AMD for $48 each. Okay, it's not $48 for all 100 calls, it's $48 each. So great, we're buying 100 shares at the strike price. And this process of buying those 100 shares at the strike price is called exercising your call option. You're exercising your right to buy those 100 shares. So we have just exercised our call option. Now, this is pretty sick because the current trading price is $48.75. So we are buying shares for a cheaper price than everyone else is buying at. So if we wanted to, we could buy 100 shares at the strike price and immediately sell them back to the market for the current trading price, where it's just like trading stock. It's like you got in at $48 and now you want to get out at $48.75. You're going to make a profit. So we bought 100 shares at $48. Now we're going to sell 100 shares at $48.75. So if you think about it, we're making a 75-cent profit per share of those 100 shares. So we make a profit of $75. So this process of exercising your call option and making a profit is the case for any call option whose strike price is less than the current share price. If you think about it, if your call option has a strike price lower than the share price, you're buying at a cheaper price than everybody else is. So you can buy at a cheaper price and sell at a higher one. So if it has a strike price below the share price, you can make a profit. And the lower the strike price is relative to the share price, the larger that profit is going to be. So call options whose strike price are lower than the current share price, where if you exercise, you would make a profit, those options are called, those options are called in-the-money options. Call options, specifically regarding calls. We'll get to puts here in a little bit, but we're going to talk about calls first. So these are in-the-money call options. And in fact, everything lower down below that would also be in the money. But what about options where the strike price is a share price? So let's say there's a call. I'm not saying it's possible, but there's a call that has a strike price of $48.75. Well, you buy 100 at $48.75 and you sell immediately all those 100 at $48.75. You've gained nothing, you've lost nothing. So you just break even. So those kind of call options, these ones right here, are called at the money or ATM. You'll see it abbreviated. And how about these ones that are above the share price? You can see the $49 is higher than $48.75. Well, you're buying 100 shares at a higher price than you can buy out at the market. Why would you want to do that? You just buy it at the market. It's cheaper. So if you exercised it, you'd buy at 49, sell at 48.75, you'd actually be at a loss. So you never exercise this kind of call option. And this is the case for any call option whose strike price is higher than the current share price. You don't want to buy at a higher price than the market's already trading at. That's stupid. You'd lose money. So these options that you would most certainly never exercise are called out of the money options. Out of the money. So OTM. And you can see I kind of color coded it here. In the money, they're awesome, super cool. At the money, who cares? Out of the money, no good, garbage. Okay, so now we understand that a call in the money call option is great. You can buy 100 shares at the strike, sell at the current trading price, you make a profit. All right, so I'm just gonna highlight this a different color here. We're gonna keep looking at this $48 call. So how do we get these call options in our possession? Well, you have to actually buy them from the seller. You have to buy the right to exercise. And you can see how much you have to pay down here. If you're looking at this $48 call, you can see, or 48 strike call, we can see that it says $2.74. But that does not mean that you're paying $2.74 to buy this call option. Not at all. It is $2.74 per share of the 100 shares that the contract controls. So if you remember, you have the right to exercise 100 shares, you're paying $2.74 per share of those 100 shares for that right. So more realistically, just cutting through the jargon there, more realistically, you're paying $274 for that call option. So if you want this call option in your portfolio, the ability to exercise at $48, you have to pay $274 to get it in your portfolio. We pay a debit. It's called paying a debit. When you pay something out of your account, it's always a debit. When you receive funds into your account, it's a credit. So now we have this $48 call in our possession, which is fantastic. This $274 is going to change. It will not stay constant. You can kind of see how it will change with the other call contracts that are less in the money. So this one's a little less in the money. It's $247 total. This one's out of the money. It's $224, $201. So you can kind of see the pattern. The further out of the money or the less in the money you are, the cheaper those call options are going to be. And this is because the further in the money you are, the bigger profit you can exercise for. So they're going to be worth more. The less in the money they are, the cheaper they're going to be because you can either exercise for a smaller profit or no profit at all. So as the share price moves around, making these call options less or more in the money, the price right here is going to shift around. Just like a share would, if you're trading AMD shares, it's going to go up and down, and you're going to buy at one price and sell at another. So in this case, let's say that we bought this $48 call for $274, but then all of a sudden this stock price, and we'll change it to blue to keep it kind of consistent there. This stock price jumps up to, let's say, even further than that. Let's say it jumps all the way up to $50. All right, that's a current trading price. This 274 is not going to be 274 anymore. It's going to change. You will not see it like that. It will not be 274. It'll change to, and I'm kind of making up a number here. It'll change to something like, let's say $400. So that now people are buying and selling this call option for $400, and you can sell this call option for $400. So if you paid a debit at $274, but now you can sell this call option back to the market for a credit of $400. You paid $274, but you received $400. That's going to give you a total profit of $126, if I'm doing that math right. So you can see that even though we have the ability to exercise, we didn't. And we can buy and sell options for the price that they're worth and make a profit or make a loss. You never have to even exercise it. And there's a real good reason why you would never want to really exercise them anyway. And we'll get into that in just a second. All right, we're going to call it for this section. So I want you to check yourself here and make sure you understand a few things. I want you to understand what a call contract or call option gives you the right to do. I want you to understand what a strike price is and how that relates to that definition. I want you to understand what premium is, why it's written as $2.47, for example, as compared to $247. I want you to understand what in the money, at the money, and out of the money is, and which ones are good and which ones are bad and why. And then I also want you to understand just what underlying means. If you can understand all those concepts, you are well on your way to getting a grasp on call options. Let's go ahead and look at this $48 call today. I like the $48 call because it's in the money. So we are going to be looking at this $2.74 of premium. This premium, we've talked about how it makes sense. This option is more valuable because you can exercise it for a larger profit as compared to like the 48.5 call or the 49 call. But we can actually tear apart this premium and figure out exactly what why it's priced like this. We're not going to look at the formula like the Black-Scholes model that would very specifically mathematically describe why it's priced like this, but we're going to look at it from a very conceptual standpoint. And this conceptual perspective on how premium is priced is very, very useful when you're actually trading options. So this is not just some theory. It's not just theory. We're not just studying theory here. It is very practical, I promise you. All right, let's take a look at this $2.74. Remember, that's per share, $2.74. This can be divvied up into two different categories. One is called intrinsic value. The other is called extrinsic value. Intrinsic value is a portion of the premium, and it is just whatever profit you can exercise it for. So we are looking at this $48 call, right? We buy 100 shares at 48 when we exercise, we sell at 48.75, we make a $75 profit, just like we said earlier in the last section. Okay, so we can say that 75 cents of premium is due to intrinsic value, which is how much profit you make when you exercise the option. So 75 cents is intrinsic value for this call option, this 48 strike call. And we'll write it here. And how about extrinsic value? Well, this is whatever's left over. So we have 75 cents for intrinsic value. So we subtract that from 274, and we are going to have $1.99 worth of extrinsic value. And this extrinsic value, what that is value given to the option because there's time left to maturity. In other words, there's time left to expiration. There's time for this option, even if it's out of the money or in the money, there's time left for it to get in the money or for it to get deeper in the money. Remember, the more in the money it is, the more valuable it is. So there's some value given to this call option because there's more time left. It doesn't have to stay it doesn't have to be, $1.75 in the money. It could be much, much deeper by the time we reach January 31st, theoretically. The share price could jump up to $55 and then it's way in the money. So there's some value that's given to it based on time to maturity. In addition to this extrinsic value is not just time to maturity, but it's also implied volatility. And I'm just going to briefly gloss over it. We'll get to it more in a second what implied volatility is, but you can think of it as the volatility of the underlying stock. Does it bounce around a lot or is it very calm? If it bounces around a lot, that's great for call options because your loss is limited to the amount you paid for it, but your upside is uncapped. It can theoretically go up forever. So volatility is very good for options. So that volatility of the underlying stock is also priced into options. You can think of implied volatility. Volatility is only important if there's time for that volatility to act. Okay, so hopefully you can see how that's kind of combined together. So this is extrinsic value. So let's pop back over to intrinsic value here. This 75 cents that is intrinsic value is going to change. And it makes sense why it would change because this call option's not going to always be only $1.75. It might be more, it might be less. So it'll change. It could be, it's just whatever you can exercise it for, whatever profit you can exercise it for. And that number is going to change. Out of the money options, you cannot exercise for a profit. So they have no intrinsic value. And I'll write that here. And intrinsic value is IV. A lot of people use IV for implied volatility, but that's not really correct. Out of the money options have no IV. They do not. No intrinsic value at all because you cannot exercise for a profit. So this part of the premium is going to fluctuate. This premium over here is also going to fluctuate based on if implied volatility increases or decreases. And we'll get to that more in a moment again. But think about it as if implied volatility increases, extrinsic value increases. They are positively correlated. If implied volatility decreases, extrinsic value decreases. And again, we'll get into implied volatility in here in a second. I just have to mention it here. Time to maturity, on the other hand, has a different effect on extrinsic value. And we're going to say extrinsic value decays as time passes. So as time passes, this number is going to shrink. Literally every day. You pay to play every day. You buy in at 274 and ignoring implied volatility, if the stock trades sideways, you're going to lose money. If the stock trades sideways, for a little bit, this looks going to drop down to 198, which means this is going to be worth 273 and you're going to lose $1. Maybe a little bit later, it drops down to 197. This will just keep bleeding off all the way up until expiration date, at which point You've either got to make it or break it. You're either in the money or you're not. And this process is called, call it time decay. It's also called theta decay, which we'll touch on here in a moment. But just know that when you buy options, the stock can trade sideways and you're losing money. Okay, so just kind of recapping what we have here. Part of this premium is literally whatever profit you could exercise for. So $75 worth of that $274 you pay is the amount you could exercise for. The extra $199 that's left over is due to time to maturity and implied volatility as a function of each other. The more time you have till expiration, the more time you have for that volatility to take effect, the more valuable your option is going to be. So both time to maturity and implied volatility are good for options. You want more time. They're going to be worth more. It also means they're going to be more expensive. So if you flip between January 24th, February 7th, February 14th, you'll see that these numbers increase the further out your expiration is because there's more time to maturity. You can actually see what we're talking about be shown on your app when you select a further out application. So they're going to be more expensive because there's more time for them to get in the money, which is a good thing. But that means there's also more money to bleed off. So if you bought an out of the money option with a far out expiration date, that will just bleed off. If you never get in the money, it'll bleed off to zero on expiration date. You're done. There's no money left. But of course, that's with call options. That's the max you could lose. You can never lose more than the amount of money you put into it. So at expiration day, nothing terrible happens. The worst thing that can happen is that it expires worthless and you don't have any money left. If it expires in the money and you have the capital set aside, it'll exercise automatically. So those are like the two options you can think of happening. This is why you would never exercise this $48 call, or very rarely would you exercise before expiration day when you have all this extrinsic value left. You may get up to expiration day and all this extrinsic value is gone and you have intrinsic, at which point you might as well just sell the option, but you could exercise it as well if you just have intrinsic value left on the last day of expiration. Because if you exercise, you'll make $75, or you could just sell this option, which is now worth $75 and make $75. There's really no difference. But let's go ahead and, just so you get the idea in your head, let's go ahead and exercise this option. So we have this $48 call. We exercise it. We make our intrinsic value. We make $75 because they're equal to each other. This $75 this $75 profit you make from exercising is built into the premium. And we call that part of premium intrinsic value. So they have to be equal. So $75 when you exercise it. However, you lose the extrinsic value. You lose $199. Once you exercise, there's no more time. You just gave up all your time. If you exercise now and there's still a few weeks left until January 31st, you gave up all that time. So you give up extrinsic value. There is no time to maturity as a function of implied volatility because there's no more time for time to maturity. The contract's gone. You've used up your right. It's disappeared. So extrinsic value disappears. So you lose $199. So if you gain 75 but lose 199, you're going to be at a loss of what? 75 minus 199. You are going to be at a loss of, we'll do it in parentheses, 124. This is why you can't just buy the $48 call and exercise it immediately. You would be at a loss. So why exercise it? You wouldn't. You'd only ever just sell the contract back to somebody else. Don't exercise it. You give up all that extrinsic value. There are certain examples where you will exercise. They're so rare that it's not worth talking about right now. Summary time, boys and girls. So when you buy a call option, you are paying this premium right here, this $2.74 per share. So you're paying $274 to buy this option. That premium of $2.74 can be divvied up into two separate categories. One is an intrinsic value. The other is extrinsic value. Intrinsic value is whatever profit you would get when you exercise the option. If you have a ticket that says get $10, use at the snap of your fingers and get $10, that ticket is going to be worth $10. So that's essentially what's happening here. This call option is a ticket to at least $75. So it's going to be built into the price of that call option. So whatever profit you get when you exercise. With out of the money options, there is no intrinsic value because you cannot exercise it for a profit. Extrinsic value is a premium built into a call option based on time to maturity and implied volatility as a function of each other. The more time you have till expiration, the more valuable your call option is going to be because it has more time to get more in the money. And in volatility is going to determine how likely that potential is that it gets deep in the money. If there's low volatility, it's less potential, so the option is not going to be worth as much. If there's higher volatility and there's more time, there's a higher likelihood it's going to swing deeper in the money. So it's going to be represented as a more expensive call option. Most of the time, you would not want to exercise your call option because when you exercise, you do technically give up all of your premium, but you also make $75 just by exercising it. So really all you're giving up is extrinsic value, and you don't want to throw that money in the garbage. That would just be throwing it at the seller's pocket. You don't want to throw it away. So you almost would never exercise. But exercising options is where this premium comes from. The ability to exercise is what drives the value behind call options. Oh, mamma mia. And lastly, while we're here, I want to touch on where you see to break even percentage. This just means the stock price has to increase by 4.08% for you to break even. Here's the dealio. I just went on a rant that was just too much. It's too much information, I think. But I was talking about the to break even percentage. And I'm just going to tell you what it is. If you want to learn more about it, I'm throwing a video up in the corner that I went into great detail about it. What it is, go away. Thank you. What it is the percentage the stock price has to move up because you have calls, you're betting on the stock going up for you to break even by expiration date. When you buy this call, you are at break even, essentially. You buy at 274, you could theoretically, we're kind of glossing over some things, but you could theoretically just sell for 274. And so you're at break even. But as time goes on, the extrinsic value decays off and that option becomes less and less valuable. You better hope the stock price goes up so that the value of the option increases to counteract this extrinsic value decaying off. Okay, so today your break even's right where you bought in. On expiration day, your break even is going to be 4.08% in the upwards direction, which is going to be the stock price of $50.74. I don't want to go any more into that because it is kind of a big topic. I guess my questions to you now to check yourself are, what is extrinsic value? What is intrinsic value? Why do out of the money options not have any intrinsic value? When there's more time to maturity, are contracts more or less valuable? And when implied volatility increases or decreases, does the value of the options increase or decrease? All right, I think that covers it for this section. Let's take a look at why volatility is good for options and how you can use it when you're trading. So let's pretend we're looking at a stock chart here. Okay, it's wiggling around, it's doing its thing. And let's say we're just kind of breaking the rules a little bit here, but let's say at this point we would be at our max loss, or our contract would be worth $1. It's never going to be worth less than $1 before expiration. You know, at expiration, if it's out of the money, it'll expire worthless. Definitely want to sell before expiration. It'll never be worth 0 before expiration. So let's say we hit 0.01, so it's worth $1. And we'll say that this area, the white area, is low volatility. And all of a sudden, volatility really picks up and we get some massive swings, right? Huge swings all over the place. Well, this is good for options because your losses are capped. Even though volatility increases, once you hit this point right here, your option is going to be worth 0.1. It's going to be worth $1. It's going to be worth $1. Down here, what's it worth? It's worth $1. Down here, it's worth $1. If the stock went down all the way to like 1 cent, it would be worth $1. Okay, it's never worth 0 until it expires. But what about when it goes up? So let's say at this point, let's say when we bought it right, let's change our color here. Let's say when we bought it right here, it was worth $250. When it swings up here, it'll be worth $400. When it swings up here, it'll be worth $800. When it swings up here, it's worth a whopping $1,600. So even though volatility increases and the potential for things to go down increases, once it hits this point, anywhere below that, it doesn't matter. It's going to be worth $1. However, when it goes up to the upside, the further up it goes, the better. Your potential profits are uncapped. So that's why volatility is a good thing. And so when people expect stocks to be volatile, options are going to be more expensive. That's essentially, in the simple terms, what implied volatility is and why it is good for options. And it is also worth noting that implied volatility is extracted from options premiums. Think about it in this way. So options prices are based around how much people want these options. If there's high demand for them, options premiums are going to be inflated. And that's what implied volatility is. If buyers of these options, if they expect that in the future, this stock price is going to be very volatile, they're going to start buying up these options because they really want them because of the reasons we just discussed. And all these buyers are going to start moving in, and that's going to push the options prices higher. So implied volatility is just that. It's volatility implied by the options premium. So when all of a sudden the options premiums get inflated, but it's not due to changes in stock price, and it's not due to time to maturity or any other reason, then it can be attributed to this idea of implied volatility. People anticipate the stock being more volatile in the future. So how can you use this in your trading? So there's mathematical models that will extract implied volatility out of options premium. So they'll extract the volatility that is implied. And it'll be described as a percentage point between 1 and 100, where 1% is very low volatility, 100% is very high volatility. This percentage is going to move over time, and it's going to be graphed out. And I'm going to draw it down here. I'm sorry. It's going to be graphed out, and it'll look kind of like a stock chart, something like this. It'll have big drops at certain points with earnings plays, which is why you never buy options on earnings. Do not buy options on earnings. Please don't. Implied volatility collapses after earnings, and so does your options premium. So never, ever buy options as an earnings bet. I'm telling you as your mom right now, don't do it. You're going to lose your money. So it changes over time. So your options premium is going to change over time, which means that if you buy an option when implied volatility is down here, and then you hold it, and then you hold it and hold it and hold it up to this point, till you're right there, everything else held constant, you're going to make money because maybe you bought this option at $2.70 worth of premium, so $270. Stock trades sideways. You don't have that much time decay. It hasn't been that long, so that extrinsic value has not decayed off really, just hypothetically. Up here, it might be worth $290 in premiums terms, so $290. So you would make $20 just from implied volatility increasing. So the idea here is you want to buy when implied volatility is low because those options are going to be cheaper. And then hopefully in the future, implied volatility will be higher because people find demand for those options. Your options premiums are going to increase due to that increased implied volatility, and you can benefit, make some profit off of that. So it's not just stock prices. That's why if you buy an option, and even excluding time decay, the fact that your premium decays off due to the passage of time, excluding that, if you buy an option and the stock price stays flat, but implied volatility drops, your options premiums are going to drop and you're going to lose money. That's another reason why if it's trading sideways, you still might lose money. People ask that a lot. So a real key way how you can use this in your trading, because you want to buy when implied volatility is low and sell when implied volatility is high, is this idea of mean reversion. When you look at a historical implied volatility chart, it's going to look not exactly like this, but we're going to say it's something like this. You could really kind of put where the average is on this graph. It would probably be somewhere right in here. And there's this idea in all of nature and all of mathematics and in options trading that things will revert back to the mean. So when implied volatility is low, when it's down here, it's going to have a tendency to revert back up to the mean. When it's high relative to its history, relative to its average, it's going to revert back down. Then it's going to go back under, revert back up, revert back down, revert back up, revert back down. And where you want to buy are going to be at these lows, because then you're going to experience this inflation of your options premiums because the implied volatility increases. And so again, we're just looking at implied volatility being graphed out. It's a historical chart of that percentage I was talking about. You don't really need to know what the percentage is specifically. Just think of it as low or high volatility as a percentage between 1% and 100%. You can buy options when implied volatility is high, but you might actually experience a contraction in your options premium, and you might have a worse loss if stock prices go down and you have a contraction in implied volatility. Premium will collapse very quickly and you'll lose money pretty fast. So the best place to find an implied volatility chart would probably be marketchameleon.com, at least as a beginner. There's better and slightly more advanced ways to do it, but for your sake, as just starting out, just learning, this is perfectly fine. So marketchameleon.com, let's look up AMD and go to volatility in the left and implied volatility. So here we are, and you can kind of see that idea where it goes down and up and down and up, and you can kind of see at what points are low, just by eyeballing it, what points are low, what points are high. You might even look at this and say that's kind of high. So if you want to give yourself a real extra edge, look up these charts on marketchameleon.com, see if implied volatility is relatively low compared to its history. And if you think that the stock price is going to go up in the future, maybe using technical analysis, maybe with a little bit of fundamentals tossed in, then go ahead and buy. And then now you've given yourself an extra edge. So not only do you make money when stock prices increase, but you also make money when implied volatility increases. Got it? Cool. So at this point, you don't have to know a whole ton about implied volatility, okay? So there's a lot to learn about it, but you don't have to know a whole bunch as a beginner. What I want you to know, or the questions I would ask you to make sure you're keeping up, are why is volatility good for options? What happens to options premiums when implied volatility increases or decreases? Why is it called implied volatility? And to think about that one a little bit, it's a little bit tricky. Why is it called implied volatility? Really, I think those are the only three questions I'd really want you to have down to understand implied volatility to actually trade with it successfully. Keep in mind when you're looking at this idea of the reversion to the mean, you're looking at its own historical chart. There is no perfect percentage. Is it high or is it low? You're looking at, is it high or low relative to its history? Because you want to have an idea of what the average is. So just keep that in mind. Implied volatility is going to tie into one of our following sections, but for now, I think this covers it pretty good. So if you understand those three questions, good on you. If you've made it this far in this video, you are getting an edge above a lot of other traders out there. So keep it up. I'm proud of you. It's a new day, so I'm wearing a new shirt. Hair's looking fresh. We are going to look at some option statistics that are very, very important to trading. So to get to this page, which is a list of statistics that pertains to a specific call option, what you're going to want to do is you're going to select a specific call option. So you'll tap on it. And then towards the left side, you'll see a bid and an ask price. And they almost look like they're a hyperlink. They're kind of highlighted a color. So you're going to tap on those guys and it'll bring up these statistics. And so we're going to break these down for you. And they're very important for trading. So we're going to break down most of them. You're going to ignore chance of profit and implied volatility. You just don't really need to know that right now. Plus, we've already covered implied volatility. Implied volatility pertains to individual options, but you can really just think of it as almost averaged. So implied volatility, like we said, is extracted from options prices. And so you can see the implied volatility that is implied by this options price. And each option is going to vary a little bit, but you can think of it as just applying to the overall stock, almost like averaging all of the options implied volatility. So you don't need to get into the details of that. Okay, so we're going to start off by looking at the bid and the ask up at the top here. The bid represents the buyers. The ask represents the sellers. Sellers want to sell at a higher price. Buyers want to buy at a lower price. It makes sense, right? Just intuitively. And you can see that represented here where this bid price is $224 and this ask price is $227. So this represents where people are buying and selling at. And you can see how many people are buying and selling at because you can see the number right next to it. So there are 58 orders at the price of $224. Those are buy orders. There are 12 orders at the price of $227. Those are sell orders. That difference between the bid and the ask, that difference there, the really 3-cent difference in premium, that is called the bid-ask spread. So a seller has to either meet a buyer at the bid price, because that's where people are buying at, or the buyer has to meet someone at the ask price, or maybe they meet somewhere in the middle. But regardless, someone's giving up some money. So if I want to buy this option immediately, I have to buy at the ask price because that's where people are selling at. That means I'm buying for $2.27. And that bid-ask spread, that 3 cents, that goes to the exchange. The people who are meeting these buyers and sellers together get the bid-ask spread as compensation for uniting those two parties. So that goes to the exchange. So either the buyer meets the person at the ask price, the ask meets the person at the bid price, so they give up 3 cents and those 3 cents go to the exchange, or they meet somewhere in the middle. So you could, to buy and exit immediately, you would have to buy at the ask and sell at the bid, and you would lose 3 cents overall because you're paying $2.27 and then selling for $2.24. You're selling for 3 cents less, and in premium terms, that's $3. So you would give up $3 to get in and out of this trade immediately. But these two, this happy little couple here, can meet somewhere in the middle. So for example, maybe the buyer puts in a order for $2.26. Well, the seller might be willing to move from $2.27 down to $2.26. And then all of a sudden you have this match together where someone's buying at a price and someone's willing to meet them at that price. And the seller is giving up 1 cent. This person is selling at a cheaper price. And the buyer here is giving up 2 cents. Because the buying price, the bid price is $2.24. So altogether, they give up 3 cents. And that 3 cents, like I said, goes to the exchange. Sorry, it's white on white. So let's get rid of this a little bit. So really all you need to think about is The closer you are to the ask price when you're setting a limit order to buy an option, the closer you are to the ask price, the more likely it's going to be filled, because then you're paying a higher price for it. Sellers don't have to meet you at such a low price. So if you want to get it immediately, buy at the ask. But keep in mind that if you buy at the ask, you're likely going to have to sell near the bid. So if the bid-ask spread is wide, which it can be, and we'll get to that in a second, you're going to be giving up a lot of money by buying immediately at the ask. So maybe set an order somewhere in between the bid-ask spread and wait for a seller to meet you in the middle. Now, when you buy an option and it's now time to sell it, you want to get rid of it, you have to sell closer to the bid. You have to sell at a more cheaper price, just like I said. So don't go trying to sell at the ask price. You're going to have quite a hard time doing that. You might set somewhere in the middle. And you can see what price is in the middle because it's called the mark price. And that is listed right here. And that's going to be the price that Robinhood displays on all of their options. So sometimes you might buy an option where the bid ask is really big. And when bid asks are very wide, they tend to jump around a lot. And Robinhood will continually show the mid price. So even if there's like no buyers, so let's say there's no buyers at all, it's going to be 0.00 on the bid side. And then on the ask, we'll write bid here. On the ask side, there might be one seller, but they're selling at a ridiculous price of like $2, $200. Well, Robinhood, even though there's no buyers, Robinhood is going to show the price as $100. And so maybe at one point your option was worth, it was showing the mark price at like 50 cents because the seller was selling at 100. But now a seller's selling at 200 and there's no one buying. It's going to show 100 in the middle. On the Robinhood platform, it's going to say you made $50. If that's a little confusing, that's okay. I'm just saying the bid ask is going to jump around, and sometimes the mark price, which is not really a realistic price all the time, is going to be the price that Robinhood shows. So you might see an instantaneous profit, but it's not real because you still have to sell at the bid and there's no buyers there anyway. So the mark price is in between the bid and the ask, and it is what Robinhood shows as the price for the option. Even though realistically you may not be buying at that price or selling at that price, you might be buying closer to the ask or selling closer to the bid. The high and low, that's the highest price for the day, and that's the lowest price for the day. The volume equals number of contracts traded. The higher the volume, the better, because if there's people buying and selling throughout the day, you want to be able to buy and sell with them. You want to maybe be able to get in and out of a trade quickly. So if there's higher volume, like this kind of volume is good, 1,455, that's good volume. If there's higher volume, you're going to be able to have people that are willing to buy from you when you want to sell an option and people willing to sell to you when you want to buy an option. If volume is very low, there may not be many people wanting to buy and sell options. You might have a hard time getting in and out of a trade. Open interest, which we're just going to call OI. And you can see that open interest is right here. Open interest is number of contracts open. So this is saying currently there are 4,114 of this exact call in existence. And they will go in and out of existence as a buyer and seller agree to create a contract, and then a buyer and seller swap sides and destroy that contract. This open interest is going to fluctuate. It's going to grow and shrink. The more open interest there is, it's going to be probably going to be higher volume. And the higher volume there is, the tighter the bid ask is going to be. So that's why it's really nice to be trading options when they have high volume, because that people buying and selling a lot is going to push that bid ask price closer and closer together. And when that's closer and closer together, you're giving up less to get in the trade. Because remember, you have to buy at the ask and sell at the bid if people aren't willing to meet you in the middle. So a tight bid ask like this, which is like 3 pennies, is great. It's not that big of a deal, giving up $3 if you have to get in and out very quickly. But if this bid ask is very wide, maybe 50 cents or $1 wide, because of the volume is so low, you're giving up $50 to $100 to get in and out of the trade quickly. So you always want to check this when you're going to buy an option. You want to make sure that the bid and the ask is tight. That's a real biggest part of all of what I've said so far is look at the bid ask. Is it tight? Are you willing to give up that much money if you have to get in and get out quickly? Think about it. All right, let's get rid of some of this. Okay, now we're moving down to the Greeks. And the Greeks are what is affecting the price of the options. And we've covered basically all of this as far as what you need to know. But this tells you how much certain things are affecting the price of the option. And it all makes sense here in just 2 seconds. We're just going to write it out here. So delta. This represents how much your options premium is going to change given $1 change in the underlying. So if this stock, if AMD goes up $1, that means that the value of your contract is going to increase by 50 cents. So you are going to make $50 if AMD goes up $1. Now you see how that's a lot of leverage. And that's the appeal of options, that they can give you a lot of leverage. This is almost like having, excluding other things, it's almost like having 50 shares of AMD, but you're only paying $227 for it. So that's leverage. And this kind of leverage might not be suitable for you. You may not be willing to lose $50 if AMD goes down $1. Okay, so it's up or down. It's positively correlated, which is why this number is positive. It's how much premium changes with a $1 move in the underlying. AMD goes up $1, you make $50. AMD goes down $1, you lose $50. Gamma, which we're not going to get into too much today, is how much delta changes giving a $1 move in the underlying. So delta is not constant. It does not say it stay at this 50 cents, which is why if you buy a further out of the money or further in the money option, they're going to have different deltas. In fact, those deltas are going to change between 0 and 1. So the further in the money you are, the higher your delta, the more leverage you have. However, if you buy maybe an in the money option for $100, but you buy 2 out of the money options for $100, so those out of the money options are worth 50 cents each in premiums terms. Those 2 out of the money options are going to give you an overall higher delta. So in other words, if you buy a couple out of the money options, they're going to give you more leverage than a single in the money option that's worth the same in premium. So just kind of writing it out as an example here, you might have out of the money options. They're worth 50 cents each. You're going to buy 2 of them. So you've paid $1 in premium. In the money, they might be worth $1 each. So you're going to buy 1 of them. So you're paying $1 of premium. However, the delta of each of these, just for example, is 0.3. The delta for each of these is equal to 0.5. However, you bought 2 of these, you bought 1 of these. So your overall delta is 0.6. Your overall delta here is 0.5. So even though you paid the exact same amount, if you buy 2 out of the money options, you're going to have more leverage than buying 1 out of the money option for the same price. However, time decay, which we're going to touch on here in a second, affects out of the money options much faster, and you're going to have a higher break even by expiration day. So they are, you're less likely to, in the end of things, make money. They're a more risky bet. If you're right, you can win big, but if you're wrong, you're going to lose big and fast. Even if the stock just trades sideways, these 2 are going to melt away. So gamma, how much delta changes given a $1 move up or down in the underlying? And gamma will change as well. But we're not going to get into that too much. Theta is how much you pay to play every day. So this is, and it's negative. So that means as each day passes, you are losing 7 cents, or, rounding up, 8 cents of premium every day. And that is actually going to increase. So every day, because of that extrinsic value that evaporates off, that value that's based on time to maturity as a function of implied volatility, that premium is going to start evaporating off as time goes on. And you can see exactly how fast it evaporates off right here in theta. This is called theta decay. So you lose, in real terms, $7 every day. And this will ramp up in speed as you get closer to expiration. In fact, the curve of, if we could graph it out here, let's say you bought in here and this is the premium you paid, it's $2. And right here is expiration day. The value of your option is going to look something like this. Where initially, when you have a lot of time left to expiration, the theta decay is going to not have very much effect on the value of your option. It's going to, stay relatively flat, might bleed off a little bit. But as time gets closer and closer to expiration, it's going to really, really ramp up. And you can see, because the expiration of this AMD option I have selected expires in like a week. So you can see how as each day passes, a large portion, like $7 of that bid, that $227 that you would pay for now, evaporates every day. And that's going to ramp up until expiration day. And then all that extrinsic value, that value based on time to maturity and implied volatility, is gone. And your option's either in the money or it's not. It's either worth something or it's worth nothing. If it's out of the money, it'll expire worthless. So keep that in mind. That's another reason you might buy an option that's further dated out, is because you're going to not be paying as much to play every day. It's going to be trickling out very slowly. So when you combine buying out of the money options with a near expiration, you are giving yourself a lot of leverage. They're very cheap, so you can buy a lot of them, and you're giving yourself a lot of leverage if things move big fast. But if they don't move big fast, all of a sudden, you're going to be down a lot of money, because that extrinsic value, which is all that constitutes out of the money options, is going to evaporate very, 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 very fast towards the end of its lifespan. Okay, so delta, how much the options premium changes given a $1 move up or down in the underlying stock. Gamma, how much delta changes given that same $1 move. So delta changes by a factor of gamma. The more in the money, as with a call option, the more closer to 1 delta is going to be. The more out of the money, the closer to 0 it's going to be. With puts, you'll see that it's going to be -1 and 0 because with puts, you're going to be betting on the stock going down. So when you're betting on the stock going down, it's negatively correlated. So if the, if delta is -0.5 for a put, that means if the stock goes down, you are going to make $50. If the stock goes up, you are going to lose $50. So they're inversely correlated. Stock goes up, you lose $50. Stock goes down, you make $50. They're inversely correlated, negatively correlated. But we'll touch on puts more in a minute. Once you get calls down, puts is easy, I promise you. Vega. Vega is how much your premium is going to change based on a 1% move in implied volatility. So if implied volatility increases, you are going to make $4. So Vega, how much premium changes given a 1% move in the implied volatility? So almost like how delta is to the stock price, Vega is to implied volatility. So you can see there's a positive correlation, and that's going to be positive for both calls and puts. Implied volatility is both good for both calls and puts. Rho is a tiny little baby guy that barely moves the needle. It is, Rho has to do with changes in interest rates. When interest rates change, they're going to affect the value of your options. But it's so insignificant and not worth even bothering with that I'm not going to go into it. So don't worry about Rho. So these are the questions. It's kind of a beefy section here, even though we went through it pretty quick. It's not like the concepts I think are not terribly hard. There's just a lot of information here. So these are the questions that I would ask you to make sure you're keeping up. What is the bid price? What does it represent? What is the ask price? What does that represent? What is the bid-ask spread and why is it important? What does Robinhood display as the options price? The bid, the ask, or the mark? What is volume and open interest, and how does volume affect the bid-ask spread? In other words, if volume is higher, does the bid-ask spread get smaller or bigger, and vice versa? And then basically run through all the Greeks. What is delta? What is gamma? What is theta? And what is vega? All right, if you have those down, good on you. I'm proud of you. Let's move on to the next section. So in this section, we're going to describe a lot of what we've already gone over, but in a visual kind of way. And then we'll also look at a certain type of diagram that is often used when explaining option strategies. So you'll see this diagram in the future when you move on to things like bull call spreads or credit spreads or whatever. You're going to see this diagram that we're going to talk about. So it's important to know. On the left here, we have a premium diagram. It's a diagram of premium. It's not like a very fancy diagram. And on the right, we have a profit loss diagram. So on the left side, this y-axis is going to be premium, and we're talking about calls. So it's going to be call premium, and that's going to be denoted as C. So we have call premium on the y-axis, and then on the x-axis, we have stock price, and we're going to denote that as S sub 0. So essentially, this blue hockey stick looking guy is your call premium given different stock prices. So basically, any stock price below this point, your call premium is 0. There's no call premium. You're at your max loss. Once you hit whatever this stock price is, you start making money and your call premium goes up such that maybe right here it's $1, maybe up here it's something like $2. Okay, and we're gonna leave one of those there because we'll need it here in a minute. And this is all on, I guess I should say, this is all on expiration day. Every bit of this is all at expiration. So we're looking at, if you remember, this is after all that extrinsic value is gone. So we are looking at intrinsic value. So what is the intrinsic value of this option? What is the value of this option on expiration day, given different stock prices? And on expiration day, if the stock price is below your strike price, that means your call is out of the money. You can't exercise it for a profit. It's worth nothing. It has no intrinsic value. It's out of the money. You exercise it, you lose money. So there is no intrinsic value. So when it's below your strike price, that means your call's out of the money. So it's going to be worth nothing on expiration day. There's no intrinsic value. So we're going to choose a strike. We'll say strike equals 20. So that means that this stock price right here is $20. And after that point, you start making money. And if we're talking about intrinsic value, we know exactly what the stock price would be when you're making $1 in premium. It would be 21. Because if you're $1 in the money, you exercise it, you'd make $100, $1 gain per share of those 100 shares. So if you make $100 when you exercise it, that means that the call must be worth $1 in premiums terms. So we know exactly what the stock price is when the call option is worth $1 on expiration day. So this is all a lot of what we've been talking about, just kind of drawn out. But any day prior to this, and this is at expiration, remember, any day prior to this, it's not going to look like this hockey stick right here. It's going to look a lot different. So let's say maybe a few months back, the premium's going to look something like this. So that instead of it being worth $1 when it's at 21, when the stock price is at 21, it's going to be worth something like, we'll kind of estimate here, we'll say it's something like $4. We'll kind of scribble this out now, bring it up here. So strike is 20. So there's all that extra value given to this call option based on time to maturity and implied volatility. Whoa. And we call that extrinsic value. So the difference between these two is that extrinsic value, which is $3. So it has $1 of intrinsic value because that's what you can exercise it for. And it's now worth $4 at that stock price when it's 2 months earlier. So there must be $3 worth of value based on time to maturity and implied volatility. So basically, any of the area underneath this curve is extrinsic value. It is this value given to the option based on time to maturity and implied volatility, which will slowly decay off. So over time, as time passes and time goes on, this curve is not going to stay the same. It's going to slowly start shrinking down. So like maybe after another month, it's going to be right there. And you'll see that your call options value is going to decrease. So maybe now it's at 350. We'll get rid of that just to keep things nice and simple. And then maybe a little bit later, it's looking something like this until on the last day of expiration, it just is that blue hockey stick graph. All that extrinsic value is gone. You can either exercise it for a profit or you can't. So this process of the options premium decaying away, the extrinsic value of the options premium decaying away until all that is left is intrinsic value, the blue hockey stick. That process is called convergence. So there's intrinsic value at the bottom. If it's in the money, there's some intrinsic value, and it's going to be at the bottom. On top of that is extrinsic value, the value for time to maturity and implied volatility. And that's going to be decaying away as time passes. So it'll shrink down until there's no extrinsic value left. All that's left is that intrinsic value. If it is in the money. If it's out of the money, then there's nothing left. There is no intrinsic value. You cannot exercise it for a profit. So that process of extrinsic value converging on intrinsic value is very appropriately named convergence. On top of that, this extrinsic value is going to shift based on implied volatility like we discussed. So it might shrink down if implied volatility decreases, and you'll see that that causes a decrease in your options premiums. Now it might be $3 down there. If implied volatility increases, then maybe this line will increase like that. And now it's going to be worth more than it would otherwise. So maybe it's worth something like $5. So that yellow line is going to bow in and out based on expansion and contraction of implied volatility, and it's going to shrink overall as time passes inwards until it becomes that blue hockey stick, and that process is called convergence. Got that out of the way. So that's basically the concept we've been talking about, just kind of drawn out. So over here on the right, we have a little bit of a different diagram that you see often when you're learning new option strategies, like I said before. On the y-axis, instead of having the call premium, you have your profit or loss. So this blue hockey stick is the exact same over here, except for instead of looking at call premium, we're looking at how much money you've made and how much money you've lost. So we're going to say that when you bought this call, we're going to say the call premium was $1. So you paid $100 for this call. In addition, like we said, our strike price is 20. So we're going to put 20 right here. If you're out of the money on expiration day, you have lost everything. If you're in the money, there's a certain area where you make less of a loss, and then you start making a profit right over here. Ooh. So if you're out of the money on expiration day, your max loss is going to be whatever you paid for that option. And you paid $100. So you lose $100 if you're below your strike. Now, right here in the middle, right at the x-axis, it's not good nor bad. You are at your break even. You neither made money nor lost money. And you can see that because your profit and loss, as it's graphed out, crosses the x-axis right there. So this is your break even. Right there's your break even. You've neither made money nor you lost money. And I know exactly what the break even is because the break even is equal to your strike plus the premium you paid. Because let's think about it. It's kind of not super intuitive, but let's think about it. If we are at $20 and we exercise that option, what's going to happen? Well, we're going to buy 100 at 20, right? We're going to sell 100 at 20 because that's the current share price. We neither make a gain nor a loss. We're at zero, but we give up the call premium we paid. When you exercise that option, the value of your premium goes to the seller. You don't get to keep that money. So you get zero, but you also lose the money you put into it. So you're at $100 loss. Okay, so let's think about that then. How do we make up that $100? Well, we have to hope that that this gets $1 in the money, because think about it. If we can exercise at $20, but if the current share price is 21, we can sell for $21 each, and we are going to make $100 profit. So if we make $100 profit, but we give up the call premium, it goes to the option seller when we exercise, then that means that we are going to lose 100 and we are at break even. So we're talking about this in the context of if you exercise or not, but you have to also think about the value of your contract on expiration day is whatever you could exercise it for. So your break even right here at $21 that's going to be the value of your call contract. It's going to be how much you put into it. So if you paid $1 for this call contract at $21 on expiration day, that's your break even price. You are going to neither have made any money nor lost any money. You would sell it for just break even. You could also exercise it for break even, but what's the point? You might as well just sell it. And this is where the math on expiration day is very easy. If the stock price is 22, we draw a line up here, we draw another line in over here, we've made $1 in premium. I guess I make it green, huh? We've made $1 in premium. I don't have any questions. Make sure you're tracking. This is like extra. Like if you get this, then you really have a deep understanding of what we've talked about so far. If you don't really get what's going on here, but you have a more a practical conceptual understanding of what we talked about, that's totally fine too. So this section and the following section, we're going to be tying a lot of the stuff we've learned so far together and learning a couple new things along the way. We're starting to move into the area of putting the bigger picture together, putting everything together and see what it looks like on the big picture and how it looks like when you're actually trading these things. So we're zooming out a little bit here. What we're looking at here is optionsprofitcalculator.com, which is where you can like enter an options trade and see what your profit or loss would be given certain dates and different stock prices. So you'll kind of see what I'm talking about here when we put one together. So if you didn't catch me there, I clicked on long call because we're talking about calls here. So we're bullish on the underlying stock. We're going to do AMD again, and we're going to buy an option. So it says buy, and the option we're going to be buying is a call. So we're going to choose an expiration date that's a little bit further out. And if you look at these at the money calls right here, so this one's worth 77 cents in premium. If we move it out to March 20th, it's now worth 458 in premium. So that extrinsic value has expanded because of the time to maturity and as a function of implied volatility. So you can see the bid, mid, and ask, and the mid is the same thing as saying the mark. It's the middle of the bid and the ask. So we are going to buy at the ask price because we want to get into the trade very quickly. So we're going to buy at $4.65 of premium. So we're buying the March 20th call as a 48 strike. We're paying $4.65 in premium, which is $465 total. So you can see the total cost is $465 right there. And we are going to hit calculate. So on the y-axis this time, we have stock prices. So right now, AMD is trading between 48.50 and 49. At the top, we have different dates. So here's January, February, March, April. So at what stock price and what date, what is your profit and loss going to be? So on the first day, if things bump up roughly 50 cents or so, you hover over that, we'll be at $49. The stock price will be $49, and we will have made 14 bucks. Pretty nice. We go up further. If today things really go up like crazy, go up to 54, you make $349, which would be awesome. So you can play around and kind of see like, where do you think the stock price is going to be? You know, when you buy this call option, what's your profit loss going to be? But notice how, see this black line right in the middle, that's the current stock price. Notice how this red starts bleeding up into the upper half. So that if right here, when you're making $14 today, if the stock price stays at 49 through January, through February, through March, all of a sudden you're gonna be down $304. You're gonna be down a lot of money. And that is because of that convergence, that premium decay. While your option right now is worth $465, as time passes, it's gonna be worth less and less and less and less, so that if you sold it, you would be at a loss. So you're losing money, losing money, losing money. And that premium decays all the way up until expiration day, where you're either in the money past your break even or below your break even. And you can see what your break even here is. It's $52.65, which is the current stock price plus the premium you paid. So if we look at our break even, you know it's in between these two stock prices. But remember that little region where I told you about where you're not at your max loss, but you haven't made profit yet? That's this whole area right here. You haven't hit your max loss until you hit that minus 100, which just means minus 100%. So that's that whole area there where you could exercise it. Or you could just look at the intrinsic value, the value of the option, and you could sell it for not a total loss, but for a significant, potentially significant loss. You won't really reach your max loss until you hit the strike of your option, which is $48. See how it's 48? We hit our max loss when we are at $48. We must be above that to have less of a loss, and we have to be past our break even to start making a profit on expiration day. But remember, at the very beginning, the very first day, your break even is right where you started. You know, you buy in, you sell immediately, you would only lose whatever the difference between the bid ask is. But really, you're at your break even. But as time goes on and as that theta decay happens and that extrinsic value evaporates off, that process of convergence occurs, you are going to have to hope that the stock price starts moving up quickly. Now, we chose an option that's somewhat at the money. Let's choose one that's very in the money. So we chose a 48 strike one. Let's choose one that's all the way at $40. So it's much, much more expensive because it has more intrinsic value built into this premium. So we're going to go ahead and click on this guy. $990 is how much it would cost us. Hit calculate. Notice how the green doesn't leak up so much into this because so much of that premium is made up of intrinsic value and is not as much affected by theta decay. As we spoke about earlier, the options that have the highest amount of extrinsic value, which is the value that evaporates off, are going to be at the money. So if you go in the money, it's going to be significantly less, damaging. Theta is going to be a smaller percentage of the overall amount you paid for this option. So it's going to have a less significant effect on the option. So our break even is much lower and our max loss is also going to be much lower because we're deep in the money. We hit our max loss when we hit our strike price. So in the money options are a lot less risky in that sense that their break even is much lower, but they're also much more expensive. So you have to keep that in mind. Are you willing to fork up that much cash? Look at the deltas. How much is the options premium changing based on $1 of the stock price move? Is your risk tolerance in line with that? You have to be thinking about this sort of thing. Now let's also play around with implied volatility, which you can do by hitting manual entry options. If we change implied volatility from 53 up to something crazy like 80, notice how the green starts dropping into the lower half. So if all of a sudden nothing else changes, but today implied volatility just spikes like crazy, which is good for call options and put options, you are going to make money even though the stock price hasn't changed. So right where our break even normally would be, we're up $173. The exact opposite would happen if implied volatility decreases. The red would start seeping up into the upper half. However, you have to keep in mind that your break even stays the same. Everything on expiration day stays the same because remember, on expiration day, there's no extrinsic value left, which implied volatility affects. It's only intrinsic value that's left. Can you exercise it for a profit? Yes, no. Now, let me tell you guys what a lot of people do when they first start trading options. They're going to choose an expiration that's very close to us. So a couple days out, they expire this week, and they're going to choose one that's way out of the money. So we'll do 50 strike, which is way out of the money, and they're going to buy a bunch of them. So they'll buy 25 of these, which is $475. It's pretty cheap. And if you look at it, if things bump up just a couple bucks, you've made $1,000. You've over doubled your money. However, they have to go quick. It has to move very fast. You only have a few days before all that extrinsic value, which these options are completely made of, evaporates. So it has to move very fast. And people do that all the time. And the problem is the stocks don't move that fast most of the time. So you can get lucky and you can make a bunch of money very quickly. But if you try this trading strategy, then it's not a strategy, you will lose money because you're always going to be trying to outrun the stock and you're not going to be able to do it. And not only that, people do this before earnings because they think, well, hey, I want the stock price to move quickly, then I might as well do it around earnings calls where there's usually big stock movements. Price movements in the stock price. However, leading up to earnings, implied volatility is increasing because there's an expected volatility in the stock because the earnings is going to cause a pretty significant movement in the stock price. So that's being priced into the options. People are paying more and more for them because they expect this large move in the stock price due to earnings. However, the day after earnings, implied volatility drops because that binary event has already occurred. It no longer is in the future. It's already happened. So implied volatility drops. In other words, people start paying way less for those options that they were paying for literally just a day ago. So let's go ahead and simulate that. We've bought all these out of the money options. So we're thinking, okay, the stock's gonna move 10% on earnings. But then all of a sudden implied volatility drops in half when we're down near, let's say 16. Hit calculate. Now look at us. Look at that. The next day it drops down. Even if the stock price goes up, we've lost money. And that's why options are so complicated sometimes. And that's why you don't want to do these stupid kind of things. If you want to be safer, learn about spreads, which you can find on my channel, but also buy in the money options. Even though they're more expensive, don't put all your portfolio in it if you can avoid it. But even though they're more expensive, they're going to have a lower break even. They're going to be less affected by theta. So time decay is not going to be as substantial. And overall, they're just going to have a higher probability of profit. All right, let's actually do a real trade here so you can see the whole process. Let's do SPY, which is the S&P 500 ETF. talk about a bullish trend. So let's go ahead and look that one up. This ETF has insanely liquid options. So the bid ask is going to be pretty much always 1 cent wide, which is terrific. So we're going to buy it for a month out, roughly February 21st. And just because I don't have that much money free on this account, let's go ahead and tap on the 329 call and tap on its statistics. So we're looking at it. Bid ask is tight. It's 1 cent, which means we'd lose $1 getting in and out immediately, which we're about to do. Volume is, of course, high. It's always high on this ETF. Delta is 48, so we make 48 bucks if the stock goes up, 48 if it goes down, this ETF, I mean. So we're going to buy one contract, which is for 100 shares. You can see that underneath there. And the bid ask is 389 to 391. Let's go ahead and see. We can put it in for 390, which is the bid right now, and hope that the price of the option drops down so that 390 becomes the ask, which it just did. So let's go ahead and enter it. 390 is the premium we're paying, which is the ask. So we're going to get it filled immediately. The max cost is $390. Hit review, swipe it up. Order received. We'll wait a second, see if it gets filled. And it got filled. Look at that. So if we go back to our home menu, you can see this option is going to pop up here, hopefully in a second. There it is. All right, a SPY call has popped up. And we have not made money. We have not lost money yet. It's just at $0 as a total return. And you can see what the last price was, is $390. How much money I put into it, $388. Now if we go to total return, we're down $2 already. So let's say, you know what, I'm having a change of heart. Let's go ahead and sell, and we want out as fast as possible. Well, we can tap on that call, hit trade, hit sell, and we're going to sell one of them. And we have to sell near the bid price, or we have to hope that it pops up, the price pops up a little bit. So it's dropping a little bit. So let's go ahead and sell it. So I'm not spending too much money on this example. So let's do 384. I think that's fine. And we'll send it off. So that's not super near the bid, but it's not exactly the bid, but it was close enough to the bid that someone either met me there or the price changed enough so that it became the bid price. So there you go. We went in and we went out, and I think we're down like $6, you know, whatever is worth it for this example. So that's what you're going to do when you buy options. That's kind of what it feels like to buy and sell options. And that's basically it. You take a look on options profit calculator, take a look where you think the stock price would be if it goes up or if it goes down. Are you comfortable with your risk and do you think you'll make a good enough profit? Then great, go for it. Go on Robinhood, select the call and buy near the ask or at the mid or above. Or if you want the stock price to move down to you a little bit, you can enter a price that's a lot lower than the bid-ask spread and hope that spread moves down over time and that you get filled. But because options provide you with so much leverage, I definitely want you to check out my videos on vertical spreads, which I will put in the description below as well. Leverage isn't always a good thing because you can lever yourself straight into the center of the earth. At this point, I'm hoping that you have your brain wrapped around calls for the most part. And if you, at this point, have any questions about calls, you should ask me in the comments below. We're going to go on to puts really quick. Not a whole lot is different. The only difference is you're betting on the stock going down as compared to going up, really. There's a few other tweaks. But once you have calls down and you have it down pat, then puts are just going to come like a breeze. So here we are looking at a list of puts on AMD. Notice I have buy puts selected. And once you buy a put or a call, you can sell by choosing sell, call, or put and selecting the put that you bought. But it's easier just to do it from your home menu. It's also possible to sell puts and calls when you don't even already own them. And that's creating a contract. You're creating a contract and selling it to somebody. But that's a whole nother deal. And you have to have quite a bit of money in your account to do that. But it is part of doing spreads where you actually don't need that much money in your account. So check out those videos that I have. They'll make you a better trader and you'll make more money if you learn them. So we have buy put selected. We're looking at 4 puts here. 1, 2, 3, 4. Notice the similarities. They do have strike prices, 50, 49, 48, 47. The only difference is, if you remember, calls give you the right, but not the obligation to buy 100 shares at the strike price. The only difference is with puts, let me write that out actually. So this is for calls. They give you the right to buy 100 shares at the strike price. But for puts, this gives you the right to sell 100 shares at the strike price. Now you could own these shares already, or you may not own those shares already. So let's take a look at a put here. So we are going to take a look at this 50 strike put. And remember, the current share price is down here at 48.42. So if we can sell 100 shares for $50 each, and then we could buy those, so we'd be selling short. If you do not have the shares already, you would borrow those 100 shares automatically from your broker, and you would sell them, and then hope to buy them back at a cheaper price. So if you exercise this put option, you would sell 100 shares at the strike price. And if you don't own them, you're borrowing those shares from your broker, which is called selling short. But if you already own the shares, it's the same deal. Those shares just disappear from your account. So you are now, let's say you don't have them, you're short 100 shares for $50 each, and you can buy back those 100 shares immediately at $48.42. Since you sold at a higher price, so you received a lot of money, and then you bought back for less than you received, you're going to keep some of that money. So that's a good thing. And the money you're going to keep is going to be the difference between these two times 100, which is what? $1.58. Remember, that's in premiums terms, so you actually make $158. So in that sense, these, it's a little different than before. These ones are in the money. This is still at the money. These guys are out of the money. So it's just flipped. When you're in the money, you hope the stock price is going down. It's below your current strike price. You're out of the money if the stock price goes up. So it's just flipped. You're betting on the stock price going down. You'll still see, if you look at the options Greeks, that theta will be negative. You'll see that delta will be negative. Remember, for calls, theta is also negative. For calls, delta is not negative. It's positively correlated, because with a call, you're betting on the stock going up. So as the stock goes up, the premium increases. So that's a positive correlation. With puts, when the stock goes up, your premium decreases. So it's a negative correlation, and vice versa. Besides really those two factors, calls and puts operate very much in the same way. It's just betting on the opposite direction. And one other small difference that's worth noting is that their break even is below their strike price, because you're betting on the stock price going down. So instead of your break even being strike plus your call premium, it's going to be strike minus your put premium. Because if you think about it, when you exercise, you're giving up that premium that you paid, and you better hope the stock price has gone down enough to make up for that loss of your premium that you paid when you exercise. So with puts, just think of it. It's the same as calls. Only difference is you're betting on the stock going down. Thank you for coming along on the ride with me. You definitely, if you made it this far, God bless you. You are a soldier. Check it out, dude. We've made it like through, this candle was brand new. We made it like, it was started up there. We made it almost, half of the way, 3/4 of the way through a candle. So good on you. I'm proud of you. I love you. Catch you guys later.